4 things you need to know about Islamic finance. Number 1. Islamic finance is based on Islamic law.
This means that interest can neither be paid nor received, nor can the financial activities be used to finance activities which are forbidden by Islam, including gambling and alcohol. But does this mean that Islamic financial institutions can't lend? No. In the conventional world, a bank may be providing funding for a mortgager to finance a house. The mortgager repays the loan with interest over the lifetime of the loan, and the bank pays interest to its depositors. But an Islamic bank provides funding in a slightly different form. It uses the funds that are provided by its depositors to purchase the house, and the borrower then pays a rental for the use of that house over the lifetime of the loan, plus an amount which repays the loan over its lifetime, and the bank then pays a share of its profits to its depositors. Sukuk is very similar to Islamic banking insofar as the lender provides funding to purchase an asset, a road, a bridge, a hospital, and the borrower pays a rental income which is then transferred back to the lender. So the 2 key aspects of Islamic finance are it's asset-based and there's a risk sharing.
Number 2. Islamic finance is growing fast.
Islamic finance is growing rapidly, but still remains concentrated in a number of jurisdictions. Its strong growth reflects very strong interest on the part of Muslim populations who have previously been underserved, but also the very strong growth in a number of jurisdictions where Islamic finance had already existed. But Islamic finance isn't growing just in the Muslim world. There's strong interest on the part of advanced economies who see particularly Sukuk as an opportunity to tap the large pool of savings and interest in Sharia-compliant instruments.
Number 3. Islamic finance offers possible economic benefits.
Well, on the stability front, Islamic finance has the advantage of being asset-backed, which makes it inherently less risky than conventional finance. And in terms of growth, it serves growth in 2 dimensions. First, it provides greater access to banking to the Muslim population who have previously been underserved by conventional banks. And by tapping a larger pool of savings, this unleashes greater potential for funding of growth-enhancing investment.
Number 4. Islamic finance still faces many challenges.
So Islamic finance holds great promise for promoting macroeconomic stability and financial stability. But to fulfill these promises, 3 prerequisites really need to be filled. The first is that while standards and codes for the application of Islamic finance have been defined, these need to be deepened and applied in a more consistent manner, both nationally and internationally. And this becomes much more important as Islamic finance and Islamic institutions become more important and more systemic. Secondly, it's essential for Sharia-compliant money markets to be developed. This will allow Islamic banks to manage their liquidity in a more effective way and free up resources for them to invest in growth-enhancing projects. And then thirdly, there's a vital need for institutional reforms in the areas of tax policy, legal reforms, and capital market development, which will be needed for Islamic finance to fulfill its promise.
For more information about Islamic finance, visit imf.org.